pleasant day to you, ladies and gentlemen. How do you feel about so many credit card offers coming at you all the time? They come in the mail, they come online, in our emails, and in television commercials. Credit cards are often seen as a must-have financial tool, allowing consumers to make purchases without cash. They offer cash advances, they offer balance transfers, free checks to use any way we want to, in addition to lots and lots of fancy perks like rewards points that can be converted to cash, goods or services, cash back on purchases, purchase protection, airline miles, hotel discounts, and more. There are personal cards, 0% promotional cards, student cards, business cards, gold cards, cards with perks, silver cards with perks, platinum cards with perks, and the list goes on and on and on. There are so many different types of cards. As we use them, we are given the opportunity to keep increasing our limits so we can spend even more. These cards have become very enticing for many consumers. I recently received these checks in the mail that are being tied to my credit card, and apparently using them will allow me to live my best life. By using these checks, I will be signing a contract, agreeing to the interest rate, the fees, the date the interest will start accruing, and also I must use them by a specific date. These offers sound wonderful to us, and so we use these cards daily for just about everything. We think they are just awesome, but are they? Credit cards are very convenient and play an important role in our day-to-day lives. We use them to help us build credit, shop in stores, shop online, pay for goods and services. We use them to pay our bills, buy groceries, among other things. They provide fraud protection, travel insurance, and even warranties in some cases. However, despite all these perks and conveniences, credit cards have a darker side that may be keeping many people trapped in a cycle of debt and financial anxiety and instability. Carrying a large amount of credit card debt doesn't only affect our financial situation, it can also take a mental and emotional toll on us. Stress and anxiety about money are common side effects of living with too much debt. We experience physical, emotional, and mental health challenges as a result. Card companies spend millions of dollars with the goal of keeping us in debt. Additionally, each time we walk into a store, they offer us $5 or $10 or 10% off our purchase if we apply for a store card, which by the way carries an extremely high interest rate. Here are a few things to know about how credit card companies are actually contributing to financial hardship and keeping us poor. The credit card companies are in business to make money through interest and fees charged to consumers. One of the most significant ways they keep us poor is by encouraging overspending. When we swipe our cards, we are not immediately reminded of the money that we are spending because it is not coming directly out of our wallet or our bank account. This detachment from the reality of our financial situation makes it easier to buy things that we either don't need or we cannot afford. These companies often offer consumers high credit limits, which makes it tempting to max out the card and rack up more debt than we can realistically pay off. Many people end up using credit cards for everyday purchases, assuming that they can pay them off later. But they don't manage their spending, and this can quickly lead to a mountain of debt. Every time we use a card, we are actually borrowing money, and there is always a cost to borrow money. The loan is not free, and it is certainly not cheap either. So here are some questions that we should be asking ourselves before we borrow money. Do I actually need these items? Can I afford these items? Are they worth the cost? Which means, are they worth the current cost that I'm paying plus the interest that I'm going to be paying on the card? Does the item serve a purpose? What exactly do I need them for? Am I actually going to be using them? Can they wait until I have the funds to buy them with cash? When we apply for a credit card and we actually receive one, it is always a good idea to read all the terms and conditions, because as soon as we activate that card, we have signed a contract with the card company. Yep, it's a contract. All the terms of that contract are laid out in the terms and conditions, also known as the customer agreement and a disclosure statement, which comes in the mail with the card. Many of us do not take the time to read it. We have done the forbidden, signing a contract without reading it. Each card gives us 3 options of use. Number 1, purchases, buying anything that we want as long as it's within the limit of the card. Of course, we can go over the limit, but there is a fee for that. Number 2, balance transfers. We can transfer balances from other high interest cards, but there's a fee for that also. And number 3, cash advances. Getting cash from ATMs, using the checks that they send us in the mail, buying money orders, etc. And yes, there's also a fee for that. And by the way, each of these 3 options comes with their own interest rate. The most important part of the customer agreement and disclosure statement is the section that explains about the interest and fees. This section is a must read. If we are going to use the card, then we should at least take the time to read this section of the contract that we just signed. In this example, I have a credit card that gives me 0% interest rate for 12 months on purchases. According to the disclosure statement, after the 12 months, the interest rate on any balance existing on the account plus all new purchases will either be at a rate of 19.24%, 24.24%, or 29.24%, depending on my credit. So they are going to pull my credit when it is time to start charging me interest. If my credit does not meet their standard, my interest rate will likely be the highest they have available. So here we go. The less money we have, the lower our credit score is likely to be, and the higher the interest rate we will get, which will cause us to pay even more. Does that make sense? On this same card, balance transfers will be the same terms with one exception. The transfer must be completed within 120 days from the date I open the card. That means if I make a balance transfer on day 121 without reading the terms, I am going to assume that I have a 0% interest rate. But the reality is that I will be immediately paying 24.24% without realizing it. Some credit cards limit balance transfers at 0% interest within the first 30 days, some are at 60 days, and some are at 90 days. That's why reading the consumer agreement is so important. This scenario can get even worse. If I transfer a balance from a credit card whose interest rate is, for example, 17%, thinking that I'm getting a 0% interest, then I find out that I had missed the transfer window to get that promotional rate, and my rate is actually 29.99%. I cannot transfer that balance back to the original card at 17% because now it will be a balance transfer and not a purchase, thus resulting in a higher interest rate of potentially up to 30%. That's what is considered jumping from the pan into the fire. For cash advance, the interest rate will be 29.24%. All credit card interest payments are calculated as compound interest. That means each day, interest is calculated on the amount we owe on that specific day and then added to our balance. And remember, this is done daily. That's every day. Any outstanding balance on the card can grow rapidly due to the compound interest, making it harder to pay off the debt. For example, if I have a $1,000 balance on a card with a 29.24% interest rate and only make the minimum payment, it will take me years to pay off the debt, and I could end up paying hundreds of dollars in interest. Take a look at this statement. There's a balance of $6,183. If I only pay the minimum balance each month and do not add any additional purchases to the balance, it will take me 20 years to bring this balance to zero. At the end of the 20 years, I will pay a total of $17,623. The interest alone is $11,440. So the question is, what was the card used for? And is it worth $17,623? Alternatively, if I pay $243 per month, it will take me 3 years, saving me $8,875. When people only make minimum payments, they're not reducing the principal amount significantly, and interest continues to build. This creates a vicious cycle of debt that is very hard to escape. Many people find themselves trapped in credit card debt for many, many years, which prevents them from building savings, investing, or achieving financial goals. However, according to the disclosure statement, if balances are paid off in full each month, no interest will be charged. And again, if you do not miss any payments or if you do not make any late payments, you won't have any fees either. Next are the late fees and penalties. I believe that these are all the fees, but there could be others that I'm not aware of. Number 1, late fees. Number 2, balance transfer fees. Number 3, cash advance fees. Number 4, over the limit fees. Number 5, annual fees. Number 6, foreign transaction fee. And number 7, swipe fee. Some merchants pay the swipe fee while others will pass it on to the consumer. And it is just as it states there, swipe fee. Every time you swipe your card to make a purchase or to pay a bill, there is a fee for that. Credit card companies often charge hefty late fees if a payment is not made on time. These fees can range anywhere from $25 up to $40 or more. This adds to our debt and make it even more difficult to pay off our balance. Additionally, missed payments can result in an increase in our interest rate, further escalating the total amount that we owe. Fees can quickly accumulate, especially if a person is experiencing financial difficulties or does not have a budgeting system in place. The longer it takes to pay off the credit card balance, the more money we pay in fees, interest, and penalties, thus contributing even more to financial difficulties. Can you see how quickly we can dig ourselves into a deep hole without realizing the danger that we're in? We keep digging this hole, and by the time we are in too deep, we have no way to get out. Credit cards are probably the largest source of debt, and it is only getting worse. Both the rich and the poor use credit cards, but they are used differently. The rich mostly use their cards as a convenience and can pay their balance in full when the bill comes, thus avoiding interest, fees, and penalties. However, the opposite applies to the poor. We are the ones who pay the interest and fees and penalties, allowing the credit card companies to make billions of dollars. Instead of putting money into savings, many people find themselves pouring their income into paying credit card balances. In some cases, credit card debt can actually prevent individuals from accessing essential financial tools. For example, those with poor credit due to credit card debt can struggle to qualify for a mortgage or an auto loan. This creates a barrier to wealth building and keeps people in a state of financial instability, resulting in stress, which in turn can affect our health. Here are some rewards cards disadvantages to consider. 1. High interest rates. These cards have higher interest rates than regular credit cards. 2. Annual fees. Some rewards cards charge annual fees, which can be very, very high. Number 3. Complex reward structures. Some cards have complicated reward system, such as earning different rates for various categories like groceries, travel, dining, or gas. Number 4, forfeiting rewards. Many rewards cards come with the limitations on how points can be redeemed, and they also expire. 5, temptation to overspend. The thought of earning rewards can sometimes lead to overspending. We make purchases we wouldn't otherwise make simply because we want to rack up points or miles. Number 6, impact on credit score. Opening too many credit cards or using them irresponsibly can harm your credit score. Number 7, limited redemption options. Sometimes rewards are limited to certain redemption methods, example travel only or gift cards only. Number 8, complicated sign-up bonuses. Some rewards cards offer large sign-up bonuses, but they often require you to spend a certain amount of money within a few months to unlock the bonus. Example, they offer us $500 bonus to accept a card, but we must respond by spending $5,000 within 30 days. Danger, 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 red flag, don't do it. Number 9, reward inflation. As some people use rewards cards, some companies reduce the value of their points or miles over time. That means you might need more points for the same rewards as you would have gotten a year or two ago. Next, let's take a look at the potential disadvantages on 0% cards that we should consider. Number 1, deferred payments. Some 0% cards have a promotional period, and if we don't pay off the balance before the period ends, the card could retroactively charge interest on the balance from the date of purchase. Example, a purchase was made in January 2025. The promotion ends January 2026, and there is still a balance left on the card. So they will charge interest on that card starting January 2025. And remember, it is compound interest. See the danger? Make sure that the balance is cleared before the promotional end date. Number 2, high fees. Many cards come with an annual fee and or balance transfer fees. Transfer fees often run between 3 and 5% of the amount transferred. Number 3, short promotional period. The 0% interest period is often limited, usually to 12 to 18 months. If you haven't paid off your balance by the time the promotional period, you'll have to start paying interest, which could be high, sometimes around 15 to 29% annually. 4, risk of accumulating debt. Having a 0% credit card might make it easier to rack up debt, as you may not feel the immediate impact of interest payments. If you're not careful, you could find yourself in more debt than you can handle when the promotion period ends. Number 5, missed payments. Missing a payment could cause your 0% interest deal to be canceled and trigger a higher interest rate on your balance. Some cards may also apply retroactive interest on previous purchases if you miss a payment. So what can you do? These are some ideas to help control credit card debts. Do you have multiple credit cards? Try to get one that gives 0% interest for up to 18 months or longer if possible. Transfer all your high balances to that card and try to pay off that balance before the promotion ends. Based on the total of your balances and considering your budget, if you don't see where it will be possible to clear the balance before the end of that promotion, then don't do the transfer. It might cost you more. Pay off all your cards with balances that are low. Start with the cards with the lowest balance. Pay that one in full, put it away, and then start working your way up on the next card based on balances. If you must use a card while trying to pay off the balance, when the bill comes, pay the budgeted amount, not the minimum payment. Then add the money for the purchase you just made. For example, you have budgeted for $200 to pay on the card, and you made a purchase of $100. When the bill comes, you will actually be paying $300. Go on a credit fast. Put away all your cards and use cash only for everything. And don't forget to ask yourself these questions before you spend. If you have more than 3 to 4 credit cards, get your scissors and cut up the extra ones. Go for the ones with the highest interest rate. I hope you'll find this video helpful. Thank you so much for watching, and all the best.